Hello, I'm Debi Peverill, and you're listening to the weekly tip from painlessfinanciallearning.ca. This week I'm talking about minimum tax because many people are surprised about minimum tax. The first time they hear about it is usually when they have to pay some. So how would you end up having to pay minimum tax? It arises if you're using exploration and development expenses or flow-through shares to reduce your taxes. Now you're going to say, okay, I'm not doing that. So that's good. It also arises when you sell the shares of your small business corporation, which I'm hoping when the time comes to sell your business that you do sell the shares. You can use the capital gain exemption to reduce your tax, but this minimum tax deal works as follows. You take a look at your total income and you multiply it by a percentage, you get a number. You take a look at your net income after you've used things like the capital gain exemption and you look at the actual tax to be paid. And if your actual tax is in fact less than this minimum tax, you've got to pay the minimum tax. The good news is it's refundable. So over the rest of your life, or however long it takes, hopefully not that long, you will get back this minimum tax that you pay. But you do have to pay it in the year that it comes up. So the year you've got the flow-through shares or the year that you've got the capital gain exemption. So I'm not asking you to think about how you calculate it. What you should keep in mind is that when the time comes to sell your business, or if you're using those kind of tax shelters, that you could end up with a minimum tax. Make sure you ask your advisors about that when you're in that situation. Thanks very much for listening. Look forward to talking to you next week.